Hello, everyone. It is me, Danielle J. Mitchell, your up and coming queen of real estate, and I'm here for another episode of Tuesday Tip at 2. Hello, everybody, and it is me, Danielle J. Mitchell, queen of real estate, social media extraordinaire, and I'm here for today's and this week's Tuesday Tip at 2. First things first, I'm a licensed PA realtor. Okay, I service Philadelphia and the surrounding suburbs. And listen, if you are interested in getting a property, buying, investing, selling, any of the above or all of the above, I need you to go to book.djmrealtyco.com. Again, that's book.djmrealtyco.com, and go in there. Go ahead, schedule a consultation so we can get you started. Now, we are continuing in the series of housing trends. We are continuing in the series of housing trends, and we are talking about what the heck is going on with these mortgage rates. What's going on? What is going on in these mortgage rates? And so I'm just coming to give you a current update on what's going on with the mortgage rates and how that will be helpful to you. Now, before we jump into what's going on with these interest rates and how they are going to affect you, let's talk about subscribing. Let's talk about how you need to just push the subscribe button, hit the all notifications so that you can get all the updates of Tuesday tips as well as any shorts that I go ahead and upload. Welcome to all my new subscribers. You know I have to say welcome to you. It's good to have you on the channel. So let's get into it. Essentially, let's talk about what the heck has happened in these last couple of weeks and all that good stuff. And as of right now, and I'm basing right now off of Monday, as of Monday, interest rates have lowered even the more. They lowered on Friday and they have lowered some more. So let's go ahead and talk about it. So, as some of you may heard, as some of you may not have heard, there was a huge bank that had some struggle bus. They have pretty much gone bankrupt. And it seems there's speculation as to whether or not there is going to be a government bailout. It looked like it pretty much is. But as I tell you guys all the time, I'm not an economist. I'm not I'm not a mortgage person. I'm not any of those things. So I'm going to break it down in layman's terms as to what happened and try to give you the version that is palatable for most of us to understand who are not money people and finance experts. And so Silicon Valley Bank provides banking services to nearly half of the country's venture capital-backed technology and life sciences companies, according to his websites, right? So that is more than 2,500 venture capital firms. Okay. So for decades, they have helped many tech companies do startups and all that good stuff. Now, of course, it is risky to do a startup. So essentially, when people don't pay, they have to borrow from other spaces and places. Okay. So when you're continuing to lend and continuing to borrow and doing what many of us call robbing Peter to pay Paul, at some point with these big banking institutions, it can catch up to you. And suffice it to say, it has caught up to them. So what they have done, they would do what most banking institutions do. It kept a small chunk of its deposits in cash and used the rest to buy long-term debt like treasury bonds, right? And then when it's time to pay back things, they can't pay the piper. Okay. So we're factoring in what happened with the pandemic stimulus and all of that good stuff, and with the Federal Reserve trying to combat inflation by having interest rates go up. All that to say is that they could not pay the piper. And so when most of us can't pay our bills, that becomes problematic. You begin to go bankrupt. Now, of course, when banking institutions do it, that swings there's a huge swing in the pendulum when it comes to banking institutions doing it, especially when they have their hands in so many investments, when they have their hands in stocks and bonds and all these different startup companies. It just gets messy. Okay. Now, when the market and things of that nature start to become volatile, what do people do? They start pulling their money out of places and spaces. They pull their money out of whether it's banking institutions, stocks and bonds, all those good things. And then banks don't have any more money to play with if people keep pulling their money out, right? So again, they don't have money to pay their debt tours, and therein lies the struggle. Okay. So when all of those things happen, when big banking institutions have these problems, then the Federal Reserve tries to compensate when people pull their money out and it starts to affect the economy in the big picture. Then the Federal Reserve is like, well, either A, bail them out, but what we also need to do is do something with these interest rates. Okay, we got to cushion what's going on in this world. We got to cushion what's happening in America. So that's my layman's terms explanation of what happened, how it affects what's going on with the rates. So because of that, the mortgage rates have dipped twice. So instead of being, as I talked about before, at the 7%, 7.1, it went down to 6.6, 6.5. And as of today, meaning March 20th, it is all the way down to 6% and even as low as 5.875%. And that is for a 30-year mortgage. Now, if you do a 15-year or a 10-year, they're always lower. But as of today, that is where we are. So what does that mean for you? As I've been talking about this whole time, that means for you, you can afford more house. So let's look at what it looks like to afford a bit more house, because I know you might be saying to yourself, well, is it really that much of a dip? Is it really going to make a difference? Let's talk about it. All right. So I've now pulled up a Google mortgage calculator. It's actually pretty good. If you go here, good old Google, they always got the good stuff for you. So right now I put in about a $300,000 home. I put in, if you were doing a conventional loan, so this is based on conventional loan as a first-time home buyer. So we're doing 3% because it's a conventional loan, it's a first-time home buyer. Okay. And if we do that, we do a 30-year and we have interest rate at 7.0, right? Again, that is based on what it was previously before. Of course, for PA, credit score, modest, 700, 719. That's a solid credit score. Property taxes, 4,500. So that could be on the higher side of Philly, or it could be in Delaware County or even Montgomery County, right? Home insurance, about 900. Private mortgage insurance or PMI, about 240. So let's see where this gets us. That has you coming in at $2,642. Okay, that's including your home insurance. That's including the principal and interest. That's include all these factors here. That's how much the monthly total is. Now, if we change this and let's say we change it to just, let's say 6%. At 6%, you see we are down a couple $100, or a couple $100, about $200, give or take, at $2,435. Now let's have it drop a little bit more and go to that 5.875. And again, you're saving an extra $50. Okay, an extra $50. I don't know about you, but I could use that extra couple dollars for some groceries. For some groceries, that can be helpful. Now, when you look at what's the significance of this, what's the significance of a couple $100? Well, it changes your debt to income ratio. So that just simply means you can afford a little bit more house, right? So if your max budget, let's say at this rate, if your debt to income ratio was that you cannot go beyond the $2,600, let's see how much house you could potentially get. So if your debt to income ratio says you cannot go beyond $2,600 a month, right? That's your max budget. Then if you're at 5.875 or 6%, then you have some wiggle room to go in your purchase price. Let's see how much wiggle room you have to move in your purchase price. So I put in here 340. Okay, I put in here 340. So as before, you had 300,000. Now you're at 340,000. right, in your home price. And so what does that mean? That means that you can go up as far as being able to outbid somebody. That means you might be able to get a little bit more house, or maybe in nicer condition with that extra 40,000. Having that extra $40,000 can make a significant difference in the type of house that you get. Also, what area. Okay. I'm just saying. So when we're calculating and saying to you, oh my goodness, it dropped a half a percent, it dropped a full percent, it dropped a percent and a quarter. Those small changes, it may seem small, but it's the significance and changing your budget, your monthly, it makes a difference. Okay. So that's it. That's pretty much it for your market update. Just letting you know what's going on with these interest rates. It's a volatile time. I told you guys before to keep your eye on mid-March because some things were going to happen. Didn't know it was going to be a bank collapsing, but it was projected that something would happen. And here we are. So it has gone down. We'll see if they remain steady, if these interest rates hold, if they go down a little bit more, if they climb back up. We don't know. We don't know what's going to happen, but I'm going to definitely let you know, give you the scoop, and help you to be able to navigate through these times with these interest rates and with real estate. Listen, you know what to do. You need to go to book.djmrealtyco.com. Again, that's book.djmrealtyco.com to get started on buying a house, on selling a house, all of the above. Let's get it started. Or even investing, because of course, when interest rates move around, that's definitely good for investors who are using a lending institution. All right. Remember, there's no place like home, no place like home buying, no place like home selling. And I'll talk with you guys soon. Bye.